Hi, this is Craig Haskell with Haskell Value Real Estate Investor. You're listening to another exclusive interview with the leading authority in the opportunistic and value real estate investing space. Today, we are meeting at the Hilton Hotel near the John Wayne Airport in Orange County, California, speaking with Gene Trowbridge, a leading syndication expert on how to raise money for real estate value investments using syndication. Gene has been in the real estate business for over 30 years as a CCIM faculty member, teaching the syndication business to new and experienced investors. He also started, managed, and sold off a very successful real estate syndication business, giving him excellent experience to draw from. Gene is author of It's a Whole New World, a comprehensive 496-page group sponsorship how-to manual. Gene also regularly conducts intensive 3-day workshops for creating and sponsoring real estate investment groups. To capitalize in today's distressed market, many investors are eager for more information on how to raise funds from investors. This interview with Gene gives you the valuable information you need to help you make your group investment fundraising more successful. In this interview, you will learn Gene's secret step-by-step system for raising money from investors, the biggest mistake experienced syndicators are making, a unique strategy to get your deal closed when you fall short of funds, what successful syndicators do best, the 3 biggest myths floating around the group sponsorship business, Gene's 8-step syndication model, the most asked questions of new syndicators, the types of people getting into the group sponsorship business, Gene's 5 keys to successful syndication, the biggest fears of investors to forming group investments. If you are an experienced or new investor looking to raise money from investors, then I strongly recommend you study this hour-long interview with Gene Trowbridge. In fact, you should listen to this interview multiple times because this interview offers lots of meaty content for you to learn new ideas and strategies.
Gene, you've been a CCIM faculty member for almost 30 years. Teaching syndication has been your passion and your experience. With the capital markets still relatively risk-averse, how has group sponsorship changed in the last few years?
All right, well, group sponsorship has drastically changed as a result of the end of the last cycle that we had. If I'm right, the last cycle in commercial real estate was probably 2002 to August of 2007 when the commercial mortgage-backed marketplace collapsed. And during that time, during that cycle, people were able to borrow almost 100% of the money they needed to buy real estate with. So because of the huge flow of capital in the debt side of the market and the craving to buy real estate in the equity side of the market, there really wasn't a great opportunity for syndicators because properties came and went so fast that you couldn't take advantage of the syndication cycle, which is probably a 90 to 120 day time frame. But as soon as the money, the debt side of the money for sure, the spigot turned off, the market slowed down. Lenders want larger down payments. Sellers don't have the frantic rush to get their property sold in 15 days or 30 days. And all of a sudden the syndication market just exploded. I've been in this business a long time, and every time there's been a dearth of capital, specifically on the debt side, the syndication business picks up. There's always syndication, but it's cyclical, in my opinion, along with the loss of debt capital in the marketplace. As I say, if the world is made up of investors who all have 20% down payments and the bank wants 40%, let's form a group. We're going to need 2 people to buy that property.
Well, with the marketplace in the distressed arena anyways, speed is important. Deals are getting done today. It takes some cash and it takes speed. How has that affected the ability of syndicators to raise money?
that particular situation you're talking about, when a lender gets a property back and then they put it on the market and they have a self-imposed time frame to get it sold by the end of this quarter or by the end of next quarter, means the lenders aren't going to sit and wait for you to raise the money. What that's caused probably half of my clients to venture into the blind pool market. And a blind pool is where you put together a syndication, you raise money from your investors. You don't know what property you're going to buy, but you want this pool of money so that you can go ahead and strike. And back in the 80s, it was called a vulture fund. That would have been a typical term for it. So now my clients who have a track record of doing deals can go to the marketplace, and based on a business plan, we raise the money, we go to the banks, we have proof of funds, we enter into a contract, and we get the good deals. They're able to fund those blind pools, and then they can strike. It's a risky proposition for the sponsor, based on the fact that it's a hard money raise. If you don't have the track record and you don't have a stable of, I would say, pre-existing relationship with investors, you won't be successful. We've had some sponsors who tried to do blind pools, and they have not been successful raising the money. We've had sponsors do blind pools, they've been terribly successful, and they've been successful in buying properties.
How about the deal points in structuring a partnership with members or limited partners, the fees, the profit splits? How have those changed, if at all?
Based on my history in the industry from the early 70s until now, and all the surveys, I've probably done 15 surveys over that period of time into the professional commercial real estate world, the CPMs, the SIORs, the CCIMs. There's been a downward pressure on the percent that the sponsors can take out of the deals. Early on in the early 80s, my surveys and my experience, and at that time I was a syndicator myself, it was easy for us to carve out to 25% of the profits for the sponsor. As we got into the mid-90s, I saw pressure on that down to 20%. And I would say today my sponsors are carving out between 15 and 20% of the profits for themselves. And part of that is the compression of cap rates. If you go out and if you're going to buy a property at an 8 or 9 cap rate, and your investors are looking at a 7 or 8% preferred return, the load, if you would, the portion that goes to the sponsor, is certainly compressed. There was a time in the 80s when we were buying properties at 12, 13, 14 cap rates, and investors were going to take 10. There was plenty of room. But, for example, no one I know is doing a single-tenant, net-leased property that might be rented by a Starbucks or a Walgreens that they're buying at a 6 cap. No syndicator is doing that because there's not enough reward for the syndicator to do their job in the deal, and you're walking away. In fact, that's an interesting conversation that I have with my students in my workshops, is the perception when you're structuring a deal that you need to structure the deal, first of all, so that you know your investors will like the deal, and then you will take what's left over. I stress with my students, and when I can with my clients, that we try to identify the amount of rewards that the sponsor needs based on the risk that the sponsor perceives they're going to take in some sort of a present value approach, and make sure that the sponsor is going to get paid enough to take on the risk. Then we look to see if there's enough left for the investors. And if there isn't, don't do the deal. Many beginning syndicators will say, boy, I've got so much money at risk. I made a deposit with my purchase agreement that's going to go hard. I better really load up what my investors are going to get because I'm not confident I can raise money. Maybe I'll do a deal for nothing more than the real estate commissions. Huge mistake. Huge mistake. And I can talk about syndicators who have made that mistake and how it actually has backfired and hurt their investors.
Many would argue that today's real estate market offers great buying opportunities. Mm-hmm. What's the outlook for sponsors over the next few years?
My sponsors tell me I'm reacting to the marketplace now in my role where I'm not syndicating myself, where I'm representing syndicators across the country. Once again, in the professional realm of commercial real estate people, business is booming. I get multiple calls literally every day from people who are investigating syndication because they know there are great deals available. They know that quality deals are going to come on the market because of this financing issue. How are we going to recirculate the debt that's going to come due in the next 4 or 5 years? And one of the good discussions you can have is how you can replace debt with equity in a syndication. Debt is usually cheaper than equity, but when there's a balloon, you have to deal with the debt. Usually with equity, while you might pay a little bit more for it, you can avoid the balloon and you can avoid the bomb at the end of the transaction. You can just carry on. So marketplace, I think, is going to be very strong. I mean, I have in the last year added a partner to my law firm business because I just couldn't keep up with the workload that I had been doing basically by myself since 1995 or 1996 when I started this.
You wrote a book called It's a Whole New Business that offers real estate entrepreneurs a step-by-step process for group investing. Can you give us a kind of a general overview of the 8-step syndication process you write about in the book?
Here are what I think the 8 steps are in order. And I try to work this with my clients that come to us to have us do the legal work. The first thing I think we have to do is we have to have our clients form an LLC that I'm going to call the Manager LLC. The Manager LLC is really in the business of being a syndicator. You probably will use the Manager LLC over and over and over. And the Manager LLC can be formed with one person and puts you in the business of getting started. So we'd have you form a Manager LLC, get your federal ID number, open a bank account, and put some money into that entity so you can start writing checks and tracking the funds that you're using to be in the syndication business. Once that Manager LLC is formed, we suggest that the syndicator, the sponsor, goes out to look for a specific property to syndicate. Earlier I talked about a blind pool where we don't know what the property is. We just raise money based on our business plan. But in a specific property, you're going to find a property that's within your product specialty probably, and you're going to write a letter of intent. You're going to be ready to go into a purchase and sale agreement on that property. And then with a specific property, you can go to your investors and you can say, we're going to invest in that building over there. Here's all the information about that building. And that's what you should do on your first transaction, is do a specific offering. It improves your chances of raising money, in my opinion. So once we have chosen that specific offering and you've done all the real estate due diligence that you would to see if someone should buy that property, then you come back and we're ready to form the LLC that will take title to the property. And that LLC is formed by the Manager LLC. So at this point of time, the Manager LLC is in existence with the sponsor, and it forms I'm going to call it a Property LLC, which right now only has one member, the manager, and then you make the offer on the property in the name of the property LLC. Then the next step is you're going to write the legal documents that are going to allow you to go to the marketplace and raise money. We have the generic term is a private placement memorandum, the PPM, and that's really made up of 3 documents. One is I'm going to call a disclosure document. There are some rules in the securities industry that tell you that you have to give the investors all the information they need to make an informed decision. And that's what happens in the disclosure document. We're going to buy an apartment building in Houston. You have to tell the investors that in Houston there's probably mold in apartment buildings. There's probably a potential of hurricanes. You're going to buy a property in Northern California, an apartment building. Are you going to explain the possibility that there's always the possibility of rent control? Whatever it is, those are the types of disclosures you make. And in certain documents on the first page, you tell the investors they can lose all their money. You kind of have to. In the securities world, there's a document called Guide 5. And Guide 5 tells the syndication attorney exactly what has to be in the disclosure document. And we write our documents specifically to follow Guide 5. So that disclosure document has to be written. It tells all about the syndicator, all about the property, and really tells the story of the investment to the investor. Then with the disclosure document done, we can step up and write the operating agreement. And the operating agreement is simply the legal document that binds everyone together to run the property in accordance with whatever the story was. Profit splits, expense payments, whatever's happening. And then the third document in the PPM is what we call the subscription book. The investor fills out an offering questionnaire. We want our clients to know that the investor not only is accredited, in addition, is suitable. Suitability is the biggest issue right now coming out of Dodd-Frank. More important than being accredited. Accredited is just a series of, do you have $1 million? Do you make so much money? That's almost irrelevant now from the securities standpoint. They want to make sure that the person who invests is investing in something that's suitable for them, given their life as far as diversification, liquidity, other things that are in their investment parameters. So the offering questionnaire tells the syndicator, hopefully, that the investor's accredited and suitable, and then the subscription agreement is where the investor says, I want to buy X number of units in this investment, and here's my check. Those 3 things bound together are the PPM. Once you have that, we're on to the next step, which is now go out and raise your money. And once you raise the money, close the deal, and then the last step is manage your entity through the operations and the disposition phase of the property. So that's really the life cycle of a syndication, and it boils down to 8 steps.
Where do new syndicators have problems in that process?
Generally, new syndicators have problems in 2 areas. Number one, the capital needed to go out and enter into a binding purchase agreement. Do they have the money to make a down payment that's non-refundable? Do they have the money to go through all the due diligence that's necessary so that we can write the story and tell the investor, remember what the standard is, all the material facts they need to know to make an informed decision? In the real estate brokerage business, there's such a thing as buyer beware. In the syndication industry, there's no buyer beware. The syndicator has to know everything, and it's the syndicator's responsibility to tell the investor everything. We don't leave anything to chance for the investor. So the first issue really is, does the syndicator have enough money to get started? And then the second issue is, I think the syndicator is always leery on their first deal about, can I raise the money? And many syndicators want to change the order in which this business goes by finding a property, seeing if they can raise the money by going out and telling everyone about this deal they have, and then calling their securities attorney. By that time, they've probably broken a number of laws. Not criminal laws, but civil laws, and primarily they've probably blown their ability to have a private placement. And if you can't do a private placement, then you have to do a public offering. And that is, timing-wise and dollar and cents-wise, not what most of our clients want to do.
How about some of the more experienced syndicators that have been doing it for a number of years? Mm-hmm. Are there some areas that you see them making mistakes?
Most of the experienced syndicators have concentrated into a product specialty, a product type. It's apartments, it's office, it's storage. Self-storage is a popular vehicle today, and they stick within that product type. As long as they do that and they have a good inventory of their existing clients, by inventory I mean they have an understanding of what is it that their existing clients want, so they can just cookie cutter duplicate the deal and continue to raise more money from the same clients. They don't make too many mistakes. The mistakes that, and I made this mistake when I was a syndicator, one would be to change your product specialty or your geographic specialty. In my world, one of the mistakes I made as a syndicator was leaving the Southern California marketplace and going up to Portland to buy apartments. That sounded very inexpensive, great cap rate, very attractive to investors down here in Orange County. And that turned out to be a mistake because I truly didn't understand, number one, the apartment marketplace, and number two, the Portland marketplace. That was a mistake on my part. I should have just stayed right down here where I knew what was going on. And then I think getting greedy. You have two ways of going in this deal. The first way is you make your first deal so sweet for the investors that you're now trapped. You can never make more than you made on the first deal because they expect that second deal to be as sweet as the first deal. So that's a mistake you make. Or if you're going along and say, well, you know, I have so many people who want to invest with me, I can pick and choose. I think I'll increase my fees. I'll take more of the profit for myself. That's a problem I've seen go forward. We had one sponsor I'm thinking about right now who structured a deal that he was going to do, and basically the transaction was a 95% to the investors and 5% to him. He got a real estate commission going in, and he committed to invest all of the real estate commission by buying units in the deal. Now here comes and he raised a lot of money for that deal. Here comes the second transaction, and the investors expected him to do exactly the same thing. And he realized that he wasn't going to make a living. He wasn't going to get rewarded for the risks he was taking on that first structure. So that would be a mistake. Now, my experience was that at the height of my syndication career, in 1 year I sent out 1,667 K1s. And I was sending out K1s to an investor pool that was somewhere between 825 and 850 investors. So you asked me, what mistakes can you make? You can get too big without the correct infrastructure. And I talked earlier about how I do surveys over the time. And at the end of my surveys, I've always asked this one question, the same question. If you've made two mistakes as a syndicator in the past, what are they, and how are you not going to do them again? And if I took all the answers and stacked them on piles, there's two piles that just are much taller than the other piles. And the one pile says, the care and maintenance of partners is overwhelming, and I didn't plan for it. Just think about doing 4 deals in the next 2 years with 25 investors in each deal. You could conceivably start reporting to 100 new best friends. And if you're doing something else, and the big problem that a lot of my sponsors have is they're trying to run a full-time commercial brokerage business. And this is all going to take time away from going out and showing properties and listing properties. So we have to talk about that. And the second thing that the experienced syndicators tell me as far as a mistake is the risk generally was greater than we anticipated, and the rewards were generally less than we anticipated. So what's the mistake? Not totally understanding the risk-reward relationship. Probably in 16 surveys, I've only had one, I'm sure of it, only one person who ever sent in an answer like this. I wish I'd bought it a 10 cap instead of a 9 cap. That's not the issue. Generally, the real estate is not the issue. It's the people. And that's what the syndication business is all about. It's about managing a group of people that have given you their money.
You're a money manager.
I'm a money manager. A real estate, that's fine. You know, a lot of other people are going to do all the real estate things. You start managing 800 investors, you're not representing the groups in buying property. You're not doing the on-site leasing. You're not doing the property management. You have a full-time job managing the investors. That's a business. That's a business that should have a profit center to itself, not related to how the property runs. And I think you have
Maybe an asset management fee.
Well, of course, you have to pay yourself for that, and you have to understand that that's the business that you're in. And when I talk to sponsors and when I do my workshop, I try to make a distinction between what I call deal-making activities, which is what a commercial broker does. Listing commissions, leasing commissions, property management commissions. That's all attached to the property. That's got to get done somehow. But the business we're in, and that's the title of my book, it's a whole new business. The business we're in is over here trying to run this group of investors. What do they need? And it's not property management. It's not leasing activities. It's not finding financing. You hire the professionals to do that. You just manage the investors. And their lives change. Things happen.
Gene, let me ask you, where do you see a lot of the new syndicators coming from? What parts of the world, what parts of trade, where are they coming from? Are they coming from the brokerage community, for example?
I'm sure half of my clients who are doing their first deal are real estate brokers who are tired of just making commissions, making a lot of commissions every year and not having any equity to show for it, making their clients a lot of equity but not getting any themselves. So they say, well, why don't we step into the syndication role and make ourselves some equity? And that's why I got in the business. Let's use other people's money and my skill to leverage the equity. That's really what we're doing. We're taking the 25 or 40% piece of equity that we need and breaking it down into little pieces and getting it from a lot of little people and going forward and doing something that you can't do on your own and get paid for your expertise. So a lot of brokers are coming to me. The other half of the people are just simply real estate investors who've invested on their own and have run out of their own money, but have done pretty well for themselves and have friends who have said, gee, if you find another deal, why don't you take me in? There are any number of groups that I go to and speak to where the majority of the audience do not have real estate licenses. And they're thinking about how can I be a syndicator in the world, and it's almost always in the apartment product type. Everyone understands or think they understand apartments. And today, as we're speaking, this is where the financing is available, is for apartment projects. So there's a large flow of syndications into apartments by people who We're flipping houses, and that gets old. So instead of flipping houses, let's buy an apartment building or something, and let's take some investors in. That's where they come from.
What are the most asked questions by sponsors on how to create group investments?
My most asked question, Gene, I want to put together three or four people, friends and family, and I want to do a deal, but I don't want it to be a security. How can you do that? And my answer is very simply, you put together an LLC that's called a member-managed LLC. You bring all those people together and you structure it so that all decisions are unanimous and no one gets paid for doing anything. And they say, well, that isn't what I want to do. I want to make the decisions and I want to get paid. My answer to them is, sorry, that's the definition of a security. They give you the money, they pay you, you make it happen. It's a security. What's your next question? That is far and away the most common question. Another question is, when do I need to hire a securities attorney? There's a risk associated with writing a check to the securities attorney, which is not a contingency fee. It's a fee. You hire me, I do your documents. I certainly hope you raise money and you're successful, but I've done my job. Well, the client says, I can't take the risk of hiring you and doing the documents if I don't know I can raise the money. So what can I do to raise money, or at least know that I can raise the money before I go ahead and go hard on my purchase agreement deposit and hire you to do the syndication work? And my answer there is, you have to have a good inventory of your client base. You have to know that the people you have in your database want to and are capable of buying into this deal. So how can I avoid the securities laws? How can I do all this and raise my money before I have any out-of-pocket expenses? Are probably the two most asked questions that I get.
What are the biggest myths floating around in the syndication business?
The first biggest myth from my marketplace, and you understand as we've been going along here, my marketplace is made up of professional real estate people. The biggest myth is, I'm just selling real estate that really isn't a security. I'm just getting 2 or 3 people together to buy a piece of real estate. That's not a security, is it? That's the biggest myth, because it is a security. A security simply is an investment of money in a common enterprise where the investor expects to make a profit, and they give you the money and expect you to make that profit happen. So a broker, first deal I ever did, I get 3 of my friends together back in Minnesota in the 70s, all guys I went to college with, and I said, I found this apartment building. Let's buy it. You all put up some money, I'll put up some money, and I'll do everything for you. I didn't know that was a security. That was clearly a security. I made all the decisions. I totally did it wrong. I didn't learn. So there's the myth that pooling investors in a real estate transaction where someone is actually going to take control of the money and make the decisions is not a security. The other myth is that because you're selling real estate, you can advertise. And if we were looking at a flow chart, one of the first questions is what you're doing a security? And there's either a yes or a no answer. And if the answer is yes, then the next thing is what can you do or what can't you do, and what you can't do is advertise. So that's a myth that you can, as a real estate agent, you can advertise for investors because you're basically selling real estate. That's a huge myth. I think whether it's a myth or not, a lot of people think that syndication comes and goes in and out of vogue. And I think syndication is always here, but as I said earlier in the interview, it gets more prevalent when the sources of debt capital dry up. And actually real estate is what's cyclical. Real estate is what's cyclical. The syndication world is always going on. So I think those are the three myths. It's not a security. I can advertise it because I'm a real estate agent. I'm selling real estate. And the syndication business comes and goes.
What do successful group sponsors do best?
Successful group sponsors come from one or two platforms. Some syndicators are what I call social syndicators. They know the types of people that they will approach for money. And let's say you knew that you were going to raise money from a group of retired school teachers. Then you'd sit down and say, okay, what do retired school teachers want in an investment? No risk. They don't want to risk their principal. They'd probably like some fixed income. And it probably can't be too exotic in a transaction. Okay? What if you were dealing with professional basketball players? Totally the opposite. Let's spend a lot of money, let's try to triple it, and let's have something very fancy. Okay, so if you're going to be a social syndicator, the biggest thing you have to do is truly inventory what is your investor group looking for. And then you go out and find the type of real estate product and the phase of the life cycle of that product that produces the economic benefits your social group wants, and you syndicate that. Example, one of my clients up in the Northwest, Portland, has this social group of retired school teachers, retired government workers, retired technology workers. And he decided to bring out an offering that was to buy small apartment buildings, 6 to 32 units, all cash, within 2 blocks of the new light rail system that connects the Portland airport with downtown. And his operating agreement did not give him the right to borrow any money. What did he have? He had a group of people who didn't want to risk anything, but they thought this might be a good time to buy something. Let's pay all cash. We'll be happy with a 3 or 4% return because it was going to go into their IRAs and their 401ks that they had, self-directed, fully secured, a nice return 4 or 5 years from now when they're really getting ready to retire. We'll refinance the properties, pull of all of our money, and continue to hold it and generate cash. That was a strategy. His strategy of that real estate came from an absolute knowledge of his social network. Brilliant. Brilliant. If he had said, this is what I want to buy because I think it's a great real estate deal, then sat down and said, who am I going to sell a 4% yield to? He would have failed. Because today that's not saleable. But he knew. Now the other side of the coin kind of comes back to where I was. I knew a lot about self-storage. I knew about pouring concrete and building self-storage and getting it rented up, and actually we sold some of our projects to public storage. We knew the whole system. So I was a product specialist. I knew what economic benefits came from the product I was good at. Now what I had to do is go out and I had to create an inventory of investors who wanted those benefits. And we were building projects with uncovered construction loans. We were hoping to get them 50% leased before the construction loan was due, and then we'd sell it to a long-term player. So it's full of risk. No cash flow. We're buying what we were offering the investors was a relatively short hold with a developer profit. That took a special group of investors. That would have never sold to the group of investors up in Portland. Never would have sold. So those are the two types of things. And once again, back to the mistakes that investors make. I told you that I made a mistake by going to Portland and doing apartments. A product specialist who changes product type can be making a mistake. A social syndicator who changes changes product type or cycle inside the product and develops a different type of benefits is going to lose his market. So, what are you? And I always talk to my investors. And most of my sponsors are social syndicators. They all come from a background of a group of people. They know they think they know where they're going to raise their money. And it's nice if they have some experience in a product type.
Can you give us an example or two of students that have used your group sponsorship program?
Sure. Best example, without naming names, is a group up in Northern California. A group made up of a school teacher, a second grade school teacher, and a motivational speaker who got together and as a result of attending a workshop given by someone, they decided, maybe they could syndicate. And they looked for another workshop to go to, and they ended up at a workshop, not mine, but where I was speaking on the topic. And then they took me to lunch, and they told me what they wanted to do. And I said, well, here are the 8 steps. You follow these steps. You work with me or some other securities attorney who's going to follow these 8 steps, and you'll be fine. And today they have done 7 offerings. Their first offering was they raised about $400,000. The last offering they raised $3.5 million. She has retired. She's no longer a school teacher. She took early retirement, and they have an asset management company. They have a property management function. They're still in Northern California, but they have a number of properties. They're all apartment projects in Texas. Very, very successful. And then there was a financial planner with a securities license who came to me and suggested that, and this is kind of a twist on what you're asking, she wasn't really certain she had enough real estate product experience to be a syndicator, but if she could team up with someone who did, she'd be pretty effective because she had a securities license and she could go out and sell. And I said, well, wait a minute, that's one person that you can sell for. Why didn't you establish a little company? I can give you 10 referrals every month of syndicators who call me and say, I would do this if I knew how to raise the money. Why don't you set yourself up in business to joint venture with a lot of different syndicators and pick and choose just the right product for whom? Her pool of investors. She'll have some investors as a financial planner and a securities person who are looking to create net worth in a short period of time, some who want cash flow and no risk. So just one product type wouldn't work for her. So pick and choose, and she's been very successful making a business.
From your experience, what types of fundraising activities generate the best results?
One-on-one fundraising activities from people with whom you have a long-term relation. One of the things that I think is a mistake, and it's a very current mistake today, is everyone thinks, gosh, if I can get on the internet, I can raise a lot of money. Everyone wants to know how to make a website that's compliant with the securities rules, and if they can just do that and they can go on the website, they can talk to all these people, and all these people will give them their money, and that's not going to work. That just doesn't work. I think there are 4 steps to being a successful fundraiser, and I call it selling the sizzle. I think there are 4 sizzles you have to sell. The first sizzle you have to sell is you have to find someone who's interested in real estate. Today, as we're talking, there are a lot of people out there who wouldn't touch real estate at all. Why would you make them an offer? Why would you even talk to them? First of all, let's find someone who's interested in real estate. And the next thing I want you to do is I want you to sell to those people the sizzle of your type of real estate. What is it that you think is great? Boy, Texas is job growth, emerging markets, apartment buildings. Downtown LA is infill. Around Staples Center with the new football stadium is going to be infill retail and hospitality. What is it that you have that will really get people excited? Once you sell them or identify people who are interested in real estate, identify people that like the sizzle of your type of real estate, now you need to start building a relationship with them that's deeper, because you have to sell them on the sizzle of you. They're going to give you their money. Okay? Why? You got to sell them on the sizzle of why is it you that they're going to give their money to. I haven't even mentioned the product yet, have I? Finally, after you find people through this relationship building process that you know like real estate, are fired up on the sizzle of your type of real estate and have had enough time to meet you and talk to you, and really you know that they're interested in hearing from you when you have a deal, and they're waiting to hear from you, and they really want to invest with you, then present an offer to them. Too many people want to just put it on the internet and slam an offer in your face and think if they talk to enough people, they'll find money raised. They'll find money. That's not going to work. The successful people just simply develop relationships. And those people invest with them over and over and over. When I said I sent out 1,667 K1s, and I had an investor pool of, 8.25 to 850. So on the average, people had 2 investments with me. Some people had 6 or 7. They wouldn't invest all of their money with me in one deal, but they put, $100,000 in 4 or 5 deals. Wonderful. There's, diversification is a good financial planning tool. So that's the most effective money raising for private placements. And I say that because in a private placement, you really can't advertise anyhow. So how do you get to a person in a position where you can actually make them an offer? I think you have to get through the first 3 sizzles: real estate, your marketplace, and you. And if you've gotten that far, I bet you have a relationship with them that meets the requirements of letting you just go ahead and say, okay, do you want to invest?
So you're talking about building that relationship first before you even bring them a property.
Yes.
Versus most syndicators have a deal and then go out and try and solicit funds.
That's not a success strategy. I'm always talking about building your database. You're always building your database. You're always building relationships so that when you have a product, you have some idea that it's the type of product that your people want. Why would you go into a purchase and sale agreement on a product and put out money to do due diligence and hire an attorney and all that, and not have any idea whether you had a pool of investors who want those benefits? It's silly. You wouldn't do that in selling real estate. You would say, gee, I have a pool of people who want to buy apartment buildings. I have a listing. I'll go and I'll show, I have an apartment building listing. I will go show those people apartments. I'm not going to show them the Walgreens I just listed because I know they don't want Walgreens. Why would it be any different? And let me add one more thing. I think you can build your database by selling the sizzle of real estate and selling the sizzle very generically of what your vision of a section of the real estate market is. And all that would be totally acceptable under the securities rules. Anything that's generic, that doesn't have anything to do with an offer, you can do. Financial planners do it all the time. They hold generic presentations on how you can invest in real estate through your IRA. Not any particular real estate deal, but just generically that it can be done. Generically, the wisdom of having diversification in your financial portfolio. The wisdom or what's new in the tax laws as it relates to real estate. All those generic types of things. Emerging markets is a term I know we've all heard. Where is the job growth? What's the latest report that comes out of the National Association of Realtors as far as where job growth is in the country? That's very good generic information that people would love to hear. And then you'd say, and I'm tracking that market. And I'm in the Houston market every other week looking for apartments because I think apartment buildings in the Houston market is hot, and I'm basing it off of job growth. Now I can build a database with people who want to hear more about that.
Based on your life's experiences, what are your top 5 keys to success in forming a real estate syndication or group investment?
Sure. My first key to success is being realistic about the inventory of your investors. Knowing them well enough that you absolutely are sure of what they want as far as economic benefits. And that's a big picture. What type of risk do they want? What type of liquidity do they want? How much is their minimum investment capability? Do they want current cash flow? Can they wait a year for cash flow? That's the absolute number one thing you have to do. And if you do that wrong, you're very much in trouble. Because you'll find a good deal and you'll love it and you'll go all the way down the line, and unfortunately the people who you expected to buy it won't love it, and you don't have a deal. Number one. I think the next thing is if you start a deal, if you start a syndication and you start raising money, I think you have to close on that piece of real estate, especially if it's your first transaction. You will go out and you will raise some money from your friends and your family, your best first-line clients. They'll give you some money. And if you can't close that deal basically because you can't raise the rest of the money, you're going to give those people their money back. Now, the next time you go out to do a deal, they're going to stay on the sidelines. Well, Gene, let's wait to see if you can raise some money from someone else this time. We're in, but we'll come in a little later. So that's a truism. In my course, I say that's absolutely a truism. You start a deal, you must have the way to close on that property. Your own money, a line of credit, an angel investor that you can go to if you get down to 2 weeks before the closing and you know you're not going to have enough money. You've got to close that property. You've got to have a structure in your offering documents that we try to bring you. For example, $1 million property that needs substantial renovation. You probably need $2 million for the offering. I'm going to write you an offering document that says when you raise the first $1 million, you can take that money and close. Then you continue to sell and raise the rest of the money needed for the rehab. Once you've closed the property with the first $1 million, the second $1 million will be easier to raise because they know you've done it. Okay, and so that means if you're a week from closing and you only have $500, but you need $1 million, where are you going to get that $500,000? You've got to close that deal. Okay. The third biggest mistake is delegating money raising to someone else. A lot of my syndicators try to team up with other people. You're good in real estate, they say, and you're good in this, and you're good in money raising, so we got a closing in April. Then they never follow through with the money raiser and see how they're doing. If your name is on there, in my world it was Trowbridge Equity Group, Inc. Trowbridge always had to know how the money raising was going. I had professional wholesalers working for me raising money, and I was in contact with them every day. You had to know, because my first truism was I had to close the deal no matter what. So I needed enough time to plan on that, not 2 weeks, but a month, to know we were going to be short how was I going to solve that so I could get that piece of real estate closed. The next truism I have is you cannot delegate investor communications. Investors want to talk to you because you have their money. There are some staff functions that a person can fulfill, fulfilling a change of address, clerical things. But when an investor calls for you, you have to respond to them. Not being available. And what's the first thing that happens when a deal goes bad? You can't get a hold of the sponsor. Trouble. Okay, you absolutely have to be available, especially when things go bad. Not planning for the infrastructure in your company to be a syndicator. I'm just going to take an opportunity to tell you why I'm no longer in the business. I was raising money from financial planners and stockbrokers, and in the early part of my business, I was doing transactions where I was able to commit $2 to $2.5 million of my own money to start a deal, so I could follow through on my premise that if I started, I could close. My life partner and my wife and I were in tune with that. That's what the business I was in. And every time I started a deal, I knew there was a possibility that I was going to have to take all that money and I was going to have to close. And I had a pretty successful run. And one day my lead securities firm came to me and said they wanted me to step up my business. They wanted me to raise $5 million at a time instead of $2.5 million at a time. They wanted more product. They were successful in selling my product. Their investors liked it. So I had two issues. I had one, do I want to commit $5 million to the premise that if I start, I absolutely must close? And in those days, it was a $15 million project with $5 million equity. Do I want to do that? Number two, I'm overwhelmed with 825 investors. What the heck's going to happen when that's 1,600 investors and I'm sending out 4,000 K1s a year? And I just said, time out. Boy, this has been a good run. I had 16 partnerships that were going at that time, and I saw a 4 or 5 year run where all I had to do was manage properties and liquidate properties and cash in my chips. And I took that decision, and I said, thanks very much, this has been good. I went to law school because I had some extra time on my hands, because I wanted to stay in this business and be a mentor to other people who are doing this. But if I would have gone ahead, that would have been a huge mistake, because I would not have been comfortable with the staff I would have had. I would have not have been comfortable with the $5 million commitment on every deal, based on my money raisers saying, Gene, we'll do our best efforts. No guarantee they were going to raise a penny. And my guarantee is if I start a deal, I'll close it. And it just didn't work in with my life, so I stopped. And it was a great career. And I was happy I did it, and I'm very happy I'm doing what I'm doing now.
New syndicators that want to get into this business, what are some of the biggest fears, apprehensions that they have?
Well, the first fear is that they can't raise the money. The second fear is it's going to take too long to raise the money, given the fact that they found a good deal and the seller wants to close. Another fear is they don't have the ability to show proof of funds when they're going out and negotiating. So how would they ever get a deal into escrow? And then the last one is the startup costs are so much that they don't have it, and they don't. I have a very, very good story of one of my syndicators who, to make a very long story short, burned through about $300,000 of their retirement fund in 3 different stages of a deal. To extend the deal, they had to go hard on the money. And after $300,000, they said, that's it. So they went to their lead investor and basically sold the deal to their lead investor for $300,000 just to get their money back, just to get out of it. Because the family situation was, we've gone too far. Okay? So you'd think that that syndicator would never do another deal. Not true. They just learned. They learned their tolerance. And I think they've done 7 or 8 deals now. And they're very comfortable, but they know, as a couple, how far they're going to go into that business. Similar to my situation. I knew when I was going to go too far. So back to, but that's an answer to your question. It's going to take too much money to get started. I don't have enough money. And I think another thing that I see, and I do a one-day session on this for people who are just kind of they're looky-loos. Do I really want to be in this business? And that's really the theme of my one-day session. And I spend about an hour talking about the conflicts between being a commercial real estate agent in whatever you do and a syndicator in the same office, in the same marketplace, in the same product type. And I think one of the concerns that beginning syndicators who come out of the brokerage business have is dropping their eye or taking their eye off of the brokerage business to get this business started will cost them too much money. They've got to make a living in the brokerage business. Any time they spend or money they spend in the syndication business could be a detriment to that, and they just can't take the risk. And I find a lot. And plus, I think it's a huge conflict. You're representing clients on their own properties. Example, you're representing a client on the leasing of a multi-tenant retail space. And you own a multi-tenant retail space 3 blocks away. And you ask your client for the rent roll. When do the leases expire? How much are they paying? And you're in competition with them right down the street. You can do that, but you better have some policies and internal structure to do that right. Because you do that wrong once, you're going to lose your brokerage business. So you better be a successful syndicator.
You regularly hold 3-day workshops on the essentials of organizing group sponsorship. Tell us about your workshops.
My 3-day workshops are called the Ultimate Group Sponsor Workshop, and I tell all the attendees that this is the last workshop they ever have to attend on this topic. The next thing to do is to go do a deal, if they're going to do a deal. My goal is to make the attendees an extremely good client for whoever the attorney will be. Hopefully it's me. And in 3 days, I'm not going to make them attorneys, but I'm going to give them enough information so they're ready to start their first deal. And when they walk into the securities attorney's office, they're not going to be surprised by any language, any terms. They're going to say, yes, I've heard that. Let's move forward. And it's a small group of people, maximum of 30 people. It is designed to have current syndicators. Many of my clients come because they want to pick up some other piece of information that maybe they missed along the way so they can even be better. And then I get people who have other attorneys who have had experience in syndication, and we do a lot of network. We do a lot of panel discussions talking about real-life experiences, mine. I mean, when I stand up and I tell people, as I do in my book, here's the technical side of this, then I can stop and say, well, this is how it affected me. And then I could look in the audience, and I'd probably find someone in the audience that it's affected also. And you say, will you share with me? And so it's very, very detailed. We go through the 8 steps. It's built on the 8 steps. How do we do the manage your LLC? How do we find the property? What are the documents? We go through a discussion of all the documents that your attorney will draft for you. What are the sources of funds that you can find? What are the generic topics you can use to find these investors? What are the mistakes that I've seen and Kim, my partner, has seen as we go through what not to do? And gets rave reviews. Everyone gets their questions answered. It's a format where everyone brings 5 questions they absolutely have to have answered. We write them on Post-its and we put them all around the room. And the last thing I do for the last hour and a half is I go through and make sure everyone's question has been answered. I'm in that list of questions 3 or 4 times in the 3 days, but the last thing I do is, once again, I go through everything, and no one walks out of there with a question that isn't answered. I couldn't do that with 100 people, but 30 people I can do that. Very good event. I have those 3 or 4 times a year, and that information is available on my website.
I hope you enjoyed this interview with Gene Trowbridge. Gene has an upcoming 3-day workshop beginning on May 17 called the Ultimate Group Sponsor Workshop. To get details on this workshop, please visit his workshop website at www.member.groupsponsor.com. That's www.member.groupsponsor.com. To get any other information on Gene Trowbridge or to contact him, please visit his website at www.trowbridgecurriculum.com or call him at 949-855-8399. Finally, if you like this interview, you will find many, many more similar types of interviews and additional supporting information at www.valuehoundacademy.com. For any other questions, comments, or ideas, please email me at craig@haskellvaluegroup.com.